Hey folks, welcome back to the channel. This is Jason, host of Fighting Words Financial. Somebody out there looking at the live stream right now, please let me know if you folks are able to hear me. So today we're of course going to be talking about markets, and we're also going to be talking a little bit about the oil industry. And I wanted to talk about the oil industry today because that is largely been politicized. And I am, of course, don't run a political channel. I know a lot of financial people kind of run a financial or a political channel too. I really don't. So what I'm going to do is really just talk about the bare facts of the matter here. Um, a lot of what you hear in the media is being amplified through whatever political channels you are watching, and most news channels are political channels. Like I said, today we're going to talk about the bare facts of what's going on in the oil markets. And but first, let me address what's going on here in the stock market a little bit. So markets are basically kind of flat today, even though we've taken a bit of a breather. I know a lot of my folks who are concentrated in technology, the folks who watch my channel, this would have been kind of a positive day today, as most of our favorite stocks were up just a little bit. We saw gains in healthcare, which pretty much led the charge today at 1.76%. Utilities, communications, consumer staples up just a little bit, and real estate up 0.64%. Even though we saw announcements from JP Morgan that they're going to be laying off a lot of their mortgage staff. To me, this is perfectly natural. This happens anytime we see interest rates go up. Very few people who are in an existing home right now are really in a position where they can get a 0.5% better interest rate by refinancing their loans. I've spoken to a number of people in the mortgage industry lately, and they have not been doing any refinances at all since about April. And everything right now is an origination and new loans. And one of the other things happening is we're finally seeing a flood of new homes hit the market, as people are possibly anticipating that the real estate market is going to cool off, and they're trying to get into the market and sell just as soon as they can. So those are the few things we're going to talk about today. I'm going to go ahead and share my screen here just a moment. So let's talk about anything you folks want to talk about today. Let's take a look first here, like I said, at markets. Once again, the only thing up for the year, the only sector up for the year is this right here, which is energy. And we've seen a little bit of a decline from the peak of about 67% down to about 34% gains for the year. So pretty much everything right now has slid since the beginning of the year, with the only exception really being real estate. So let me know what you guys think in the comments here. But I'm going to talk a little bit about the oil industry, and let's talk about the narrative here. Okay. And I don't want to say let's talk about the narrative here like there's some grand conspiracy or anything like that. I'm not a conspiracy guy. But let's talk about what folks are saying about energy policy. This administration does not have a great energy policy. It doesn't have a terrible energy policy. But energy policy actually has pretty severe limits. This is a market that is run for the most part by markets and not by the government. And when folks are demanding that the U.S. government do something about oil prices and about sticker price shock at the pump, what are you really asking for? Does capitalism sort of solve our problems? I'm a big proponent of that, meaning that as there's more opportunity to make a profit here, we're going to see more and more companies jump into the drilling game. We're going to see more and more companies start to compete when it comes to prices at the gas pump. And capitalism, as slow as it is going to take care of the problem. What people seem to be asking for right now is intervention into the free market to do something about oil prices. There are limits to that. So let's talk about that right now. This is from the U.S. Energy Information Administration tracking U.S. crude oil production. You see that prior to the pandemic, we hit a peak of about 12,800,000 barrels per day in March of 2020. Of course, you guys know it dropped like a rock during the pandemic. We didn't see much recovery. It dropped like a rock again back in February of 2021. And that was so that was really due to a variety of issues, but it's been climbing since February of 2021, going from 9,773,000 barrels a day up to pretty close to 12 million barrels a day as of March of 2022 is 11,655,000. The U.S. has added almost 300,000 barrels onto that. So pretty close to 12 million barrels per day by June. So very close to record levels here, just about a million barrels a day short of record levels. And let's talk about what that means. So part of the reason we saw this big drop here in February of 2020 really had less to do with the pandemic and a lot more to do with Russia flooding the market with crude oil, with the express intent of taking American shale producers out of the market. That is something that is a matter of historical record. You can go and look it up. Putin said that himself, is that he wanted to reduce the amount of market share that American shale producers had, and that worked. I mean, futures were actually at negative dollars per barrel at one point once the effects of the pandemic hit, as well as other things. So there was a deal negotiated, of course, for OPEC to cut oil. That was a 2-year deal that expired in April, and we're seeing production here increase. So let's take a look here what that means as far as where oil is being produced, how many rigs there are worldwide, and what's going on in the US versus what is going on internationally. And we're just talking about facts here, and you're going to see kind of the limits of what US policy can do. So we're going to look here at rig count overview and summary. This is from Baker Hughes, and this is for international. This is not them. This is for everyone here. And these numbers you'll see updated through June 17th of 2022 and May of 2022 for international. So there are 740 active rigs, 7 been added in the last month or so, just in the United States, 156 in Canada. That's roughly a little bit more than 1,700. I did the math a while ago, but I forgot about it. Anyway, internationally, there were only 817 rigs, meaning that more than half of the drilling rigs worldwide are in the US and Canada. Every policy we have basically, we don't make up one half of the world's landmass. We don't make up one half of the world's oil reserve, proven oil reserves, or speculative reserves. We're drilling pretty much as we can. So Canada has increased by 39 drilling rigs over the last year. United States has increased by 270 drilling rigs over the last year. Now, I know someone in the comments is probably looking at drilling rig counts from 10, 15 years ago, where they were quite a bit higher than this. That really doesn't take into account there's been massive improvements in technology. Rigs are more efficient, and we need a lot fewer of them. And when I mean a lot fewer of them, about half of what we need to get the same production that we did 10, 15 years ago, right? So internationally, there's been 67 rigs added. So the bulk of worldwide increase in production in oil is actually coming from the US and Canada. US and Canadian drillers are doing everything they can within the scope of the goals that they have to increase production, meaning there was a survey done back in March talking to different oil executives, and right now they're focused on return of shareholder equity. They want larger dividends. They want share buybacks. They want to pump up the price of their stock at this point. And the priority is not producing cheap gasoline. What we need for that to happen is actually an increase in international oil production. And that has, of course, been crippled by what's going on with Russia right now. We need other areas like the Middle East and Southeast Asia and Africa to start pumping more oil to compete with U.S. drillers to drive the price down. Now, I know that sounds counterintuitive because it kind of is. U.S. drilling and production is limited by cost, meaning that when the cost of a barrel of oil goes below a certain dollar amount, it used to be about $70 a barrel. I'm not sure what that is now. But we're actually going to see a decline in exploration, and we're going to see some rigs being taken offline because the type of oil produced when it hits the market is worth less because it takes a bit more in the way of technology and refinement to get that to a workable product. So in the United States, roughly about 26% of oil use is not related to transportation, and everything else is. And you can see here, we have the narrative that we aren't increasing oil rigs, in the narrative that we're denying permits. Yes, there are permits that are being denied, but we have seen an increase of 270 rigs over the last year. That's literally close to a 50% increase in active drilling rigs over a single year in the United States. roughly the same, a little bit less than 50% in Canada. That is a massive run up in production capacity. So what is being done is being done. So this is one source of data. If we look at rig count, it's the same for Y charts, and they're getting their data also from Baker Hughes, though, so maybe that's not the best comparison. But Baker Hughes is the one that you generally rely on for this information, and the EIA also, the Energy Information Agency. So that is one of the things that you guys want to talk about or want to think about when it comes to how this issue is being politicized. The United States is doing and Canada is doing everything that it can to increase production. So anyway, so I would stop listening to the political arguments and that sort of thing, and let's start talking about demand destruction. At what point do we actually see demand destruction in the U.S. and what is causing high prices right now? So based on an industry analysis that I saw just a week and a half ago, 2 weeks, if we just looked at the price of a barrel of oil and what the price of a gallon of gasoline should be, it should be about $3.82 a gallon nationwide. What's driving that up right now is the futures market. And I was wrong about the date, by the way. It was actually August 31st is when a giant swath of those oil futures expire. And we see deliveries that need to be made between August 1st and August 31st. And we see an expiration of those futures contracts. Now, this is similar to something that happened in 2008, where we didn't see a decline in production. Yes, we saw heavy demand, but we did not see a decline in production. But we saw the futures market go crazy and drive the price of a barrel of oil up to about $147 a share. So this is similar to what's happening right now. Look for a decline in oil prices after August 31st. You should see some softening of demand anyway, as the summer travel season is going to be over, or at least close to over. Now, let's talk about the summer travel season. I just traveled in the first 2 weeks of June. I had 4 canceled flights, just trying to get to where I was going. And travel was absolute chaos. And the main thing that I heard from folks was there weren't enough flight attendants and there weren't enough pilots. A lot of those folks found other jobs during the pandemic because they had to. Being a flight attendant is actually a really tough job, and you're really paid really poorly for your first couple of years. And I understand why they're having trouble filling those jobs. The working conditions are terrible and they don't pay enough. It's not that people don't want to work. It's people don't want to work for you. I'm talking to the airlines because your pay and benefits are a lot worse than they were just 20 years ago. So, yeah. So, Sleepless Joe, Shoeless Joe, rather, thank you very much for letting me know that my microphone was working. And what do we measure for inflation once we're mostly off oil? Chips. So actually, food and fuel are not counted in either the CPI or the PPI. Those are counted differently. There's I think it's called the CPE, or I can't remember the name of the index, but that's the one that includes both food and fuel. And that's one of the things. So once we're mostly off oil is the way to think about that too. Like I said, there's never going to be no demand for oil. We use oil in plastics. We use oil in chemicals. We use oil in, or at least hydrocarbons in our fertilizer production. Particularly fertilizer production, we use a lot of natural gas. So we're never going to be completely off of a carbon-based economy. It's probably just going to be greatly, greatly reduced. So Goldmine says, I just woke up and saw that you were live. Yeah, I'm back doing lives Monday through Thursday as my schedule permits, at least an hour a day, Monday through Thursday, hopefully more like an hour and a half or so. I do have other work to do, guys. YouTube is more my hobby than my full-time job. I realize there's a lot of YouTubers out there that do this like as a full-time job. I don't. Happy to answer any questions you guys have about questions regarding the oil industry or questions regarding the stock market or anything like that. Is it time to get into oil stocks right now? Is there still time to make some money in the short term? I think there is. On a long-term basis, 10, 20, 30 years out there. I don't really feel like that's going to be the best investment, but certainly in the next year or so, you could make quite a bit here. So interesting. If you guys ever looked at where oil is produced in the United States, you look at federal offshore Gulf of Mexico, New Mexico, Texas and North Dakota are the largest producers of oil, with Oklahoma right in there. And even California producing 339,000 barrels a day, Colorado at 429,000 barrels a day. So Alaska not producing what I thought it produced. Production has been in decline there for quite some time. Have not paid attention to Alaskan production for a while. So yeah. My Eric M says, my uncommon opinion is that oil stocks will massively outperform tech during the decade of 2020 to 2030. I think that oil stocks, of course, are massively going to outperform tech this year, possibly into next year. It would not be normal for oil stocks to outperform tech over a 10-year period, though. They typically don't. Tech, you have wide enough holdings. Tech generally outperforms oil. Oil is a steady sort of 8% producer over a 10, 20-year time period, 8% annually, which is nothing to laugh at. And like the NASDAQ 100 is about a 10% annual producer with a lot more volatility, though. So oil is very cyclical, though. If you've worked in the oil industry for a long time, you are accustomed to, if you're a roughneck, meaning like an oil rig worker or something like that, you're accustomed to making $100,000 to $150,000 for a couple of years, and then boom, you get laid off and you have to go 10 bar for 6 months, a year and a half, something like that. If you're in the oil industry and you don't know this is coming, it's coming. Okay. Things are going really, really well right now. But if you're in that oil industry, that's something you need to be worried about and you need to plan for in the future. I know a lot of people that work in the oil industry that don't have a lot set aside because they don't plan for these down cycles in the oil industry, but they happen all the time. So, so I think that is an uncommon opinion. I think that historically it wouldn't match historical performance of those asset classes, but historical performance is no indication of what's going to happen in the future. But let's think about this. The electric revolution, or the electrification of transportation, is happening a lot more quickly than I actually anticipated that it would happen, especially in certain markets. Like, you can go to Texas and there just aren't that many electric vehicles. There's a few. You can go to South Carolina and they're just there. You see, every time you drive, you're going to see a Tesla. Every time you drive, you're going to see a Tesla in Texas as well. But you go to a market like California, where 12% of vehicles sold last year were plug-in electric vehicles. That's 12%. And the vast majority of these people can charge their vehicle at home using their, the same circuit that their dryer is on, that 240 volt circuit. They're leaving their house every day with, a relatively full battery, and they're not driving 220 miles in a day. They might be driving 100 miles a day, and they're coming home and recharging overnight. Especially with the profusion of solar power here in California, how cheap it is to get it here. You can basically get it put on your roof for nothing. We're going to see a lot more people turn towards solar as a solar in electric car thing. As soon as I buy an electric car, I won't be paying a dime for transportation. I put about 130% of my needs in terms of electricity on my roof, planning on an electric vehicle for the future. What I didn't plan on was how many dang devices my kids were going to use and how much electricity they were going to use. So I'm probably going to need to put an additional 4 more panels on my car to support the energy usage of a Tesla Model 3 driving about 1,500 miles per month. And that would be an overestimate of how much I drive per month. I really don't drive that much. So my electricity will be free. My driving will be free. And the only thing I'm paying for is natural gas at like $9 or $10 a month, and water. So, which water is actually pretty expensive here. But there's going to be a lot of folks in high, in environments where solar makes a lot of sense. Like, I'm talking Arizona, California, New Mexico, Colorado. Right now, the financial structure, the way things work in Texas, Louisiana, Alabama, Mississippi, and even Florida, the financial structure doesn't really work all that well for solar. But in California, because of certain financial innovations, not necessarily technological innovations, but financial innovations, it's made it really cheap for you to put solar on your roof. I expect the rest of the country to follow suit. And with the states that have the strongest oil lobbies to be the last ones to do that. So, Anyway, let me know what you think about that in the comments below, because I think that's what's going to be the main destructor of demand for oil in the future. We're also seeing some pretty rapid advances being made in bioplastics that are produced by algae, at least the precursor chemicals for those. Now, I don't know how far that is away from mass production and making a real impact on oil demand for the production of plastics. That could be decades away at this point, but I think it's something interesting to take a look at too. I've looked at a couple of these companies when it comes to investments. It's still way too early. They're still extremely speculative. So let's talk about some of the electric vehicle companies that I have not really covered on my channel. Now, a lot of times when I don't cover something on my channel in terms of an electric car company, it's usually because they're pretty far behind the curve in terms of their manufacturing process, which your technology, the technology that you have, that you claim to have, or that you claim to be able to produce, in many ways is just secondary to how much of it you can produce. Meaning, do you actually know how to build a factory? Do you actually know how to secure supply chains? And that is my biggest concern right now. We're entering into a new phase of electric car production here where Tesla really has all of the advantages here. They are the only company that's really gone out there to secure every bit of the supply chain they need to produce batteries, right? And they still can't produce battery cells fast enough to satisfy demand. You only have to look at their, you pretty much only have to look at how long it takes in order to get a Tesla once you order it. I think it's basically 6 months now is the wait time. That is only going to increase as we see, especially as we see the Tesla Semi hit the road and as we see the Cybertruck hit the road. And I saw some interesting articles this weekend on GM's Ultium battery. So far, I'm not really impressed by GM's Ultium battery. I am impressed by how much money they're pouring into research and development, though. So let me see here. Eric M says oil has had 4 super cycles, usually lasting 10 years. I think we are gearing up for another one. Emerging market demand and minimal supply response should continue. So minimal supply response is only going to continue until we start seeing the crawdad effect. Now, if you're not from the South, you might not know what a crawdad is. A crawdad's a crayfish, right? Now, if you put a bunch of crawdads in a bucket and one of them starts making progress climbing out, the other ones in the bucket will grab it by the tail and pull it back down, right? And that's essentially what happens to the industry when oil prices stay high enough. Is you're going to get enough suppliers in the game, enough people pumping oil that eventually you're going to have oversupply and you're going to see a decline in price. Now, we haven't seen that quite yet because drillers have remained in the United States relatively disciplined with production, even though they're increasing production. They basically increased rig count by close to 50% just in the last year, both in the United States and Canada. But as international producers start to get very nervous about how much market share, because remember, unlike natural gas, oil is a global market, right? A United States producer can sell it overseas. They can sell it in the United States. They can export it. They can disrupt markets all over the world. As the United States producers start to secure more of that market share, we're going to see foreign producers, which, unlike the United States, their government can literally tell them, start producing more oil. Like Joe Biden or Donald Trump doesn't have any power to go to U.S. companies and say, without basically invoking the War Powers Act, they can't go to these companies and say, you must produce more oil, right? Because it disrupts a lot of their market plans. But foreign governments around the world where oil is nationalized, they're completely capable of doing this. So, Shoeless Joe says, Elon said he'll hopefully release a 25K Tesla by 2023. Do you think they're on track for that? No, I don't. Largely because Tesla has never been on track to release a vehicle when they say they're going to release it, right? When was the Cybertruck originally supposed to be released? I think it was at the end of 2019, right? Or maybe it was at the end of 2020. And now we're looking at 2023 before we start seeing the first ones roll off. How long? He's been talking about the Tesla Semi now since 2016. He's been talking about full self-driving at least since 2015, right? So Tesla always delivers on its promises. It just tends to happen on a timeline that is on a different timeline than originally predicted. So I'm not holding my breath here in terms of that being out by 2023. I'd be enormously pleased by that. That's not a vehicle I would buy because I need a tow vehicle. I need something to tow things around. I'm looking at probably buying the Cybertruck. Although I've seen a couple of Rivians driving around recently, and they look pretty nice. They look really, really nice. So, yeah. So Amazon here, let's take a look at Amazon. Has over 10.2 billion shares outstanding. It seems to me like it'll be very hard to push the share price up. Their competitor Alibaba might be a bigger choice to make a profit. Yeah, and remember though, with Alibaba should probably be worth more than it is based on their company fundamentals. You're always taking a haircut though in terms of that China China discount. Sorry guys, I'm still a little bit sick. I tried to train last night and I was having coughing fits while trying to teach the class. And so I'm not entirely over whatever it was that I had. It wasn't COVID. Yeah. So I do think though that Alibaba fundamentally looks like a really strong company. They have a really strong position. They have an ecosystem that is unassailable to a degree, so unassailable that is kind of what not just Alibaba, but a lot of other companies were creating these technology silos where once you got into one end of their technology, you really couldn't exit. And that was the push for regulation last year in China. So you always you're always getting a little bit. The price is always discounted a little bit for two reasons. Number one, we're unsure of the regulatory environment in China. At any point, the Chinese can make policies that really affect the share price. China goes from being called uninvestable to being called the next great opportunity in the stock market. I would counsel you to have caution. There are many things that need to be worked out. We are still under the threat of delisting here. Alibaba is one of those companies where I think it would actually be very difficult to make them compliant with generally accepted accounting standards, and to have those books reviewed. Any company in China that's doing business with the Chinese government, they see that as an opportunity for Western countries and allies of the United States to gather intelligence about what China's military is doing with the private sector. Companies like I can't remember that off the top of my head right now, but there's a number of companies out there that I fully expect to be delisted. I think a lot of them will negotiate some solution to stay on. I think Neo's going to negotiate a solution. I think Xpeng will. But the one of the drone makers and one of the makers of like camera devices, I'm looking at the business that they may be doing with the Chinese government, and I'm thinking there might not be a way to make them compliant. That may be one of the companies that ends up being delisted. In that case, they'll probably have a secondary listing on the Hong Kong exchange, and you'll either have H shares or your shares will go into the OTC markets, which of course is going to cause there to be a discount there. So Eric M says, Elon said recently he thinks the world will run on solar in the future. Is that incentive bias? Nuclear seems 20 times better. So I've been a huge fan of nuclear power since I was literally like 8 years old. So it's been a very long time that I've been looking at fusion power as a solution. And there've been a number of breakthroughs over the years, but I have to finally admit, because I never get excited about those breakthroughs because it doesn't seem to amount to much. But I have to finally admit that there's two projects, one in Switzerland and one at MIT, that I'm starting to get excited about. Meaning they're already trying to spool up like sustainable reactions. The one in MIT by 2030, we should basically have an artificial sun in the United States producing relatively free energy with the waste product of helium, which I think is pretty freaking awesome. And for two reasons. Number one, well, it's not going to produce enough helium to make a difference, but it's clean energy and it's relatively free energy. But I think that diversification of production of power is the way we're going to go in the future. Solar power is the easiest, least expensive, one of the least expensive options at this point. It's been commoditized. Panels are very cheap. What costs a lot of money with a solar project really is labor costs at this point. I took pictures as I was flying from Las Vegas to California recently in the last week or so of all of these solar collection farms that are out in the desert. And there's a number of projects out there where they're basically collecting sunlight to boil water, using giant mirrors to collect sunlight to boil water to produce electricity. I expect to see a lot of that in the future. I expect to see regular photovoltaic farms pretty much everywhere. The real trick is going to be energy storage. It's not that we can't produce enough solar panels to power the entire United States. It's what do you do at night? And what do you do when in the wintertime when you get reduced solar energy? People think that just because it's cloudy, it means that your solar panels aren't producing energy. That's not true. They still produce quite a bit of energy. They do produce less because you're really looking at solar energy here, not simply just sunlight is what you're collecting. But the real problem is storage. So what we need to do, and I'm sure there are lots of really intelligent people out there working on this, is working on energy storage ideas and smart grids and how to manage that. I'm not talking about Tesla Powerwall, which is a great idea for what it was, right? What I'm talking about is grid scale level projects to store energy. Now, there are a couple of those projects being worked on right now. There's one in San Diego, there's another one in the Bay Area, and there's one in the Rio Grande Valley in Texas, where these are small town size projects where this is supposed to power 10 to 20,000 homes, and these giant batteries basically are the size, or these battery banks rather, are the size of shipping containers, and they'll have like a dozen of them together. So these projects are in the work. There's also a huge one in Australia right now, which is supposed to power up to 1 million homes by the time it's finished. So we are in a very exciting time. So I thoroughly think that Tesla's, and Elon Musk has said this before, but I think that Tesla's energy storage business at some point may be producing close to the same amount of revenue that his vehicle business is, or that the vehicle business of Tesla is. And it's not going to be Tesla's solar roof. It's a very neat thing. It's not going to be solar panels. Those are neat things. It's really going to be the energy storage solutions that I think are going to lead the way here. And we have all kinds of we have, of course, geothermal power. We have wind. We have all of this. All of those suffer from the same issues. How do you store energy to use when you're not producing? We're still going to have probably gas-fired peaker plants and things like that. I don't expect those to go away. But no, I wish we would invest a little bit more into nuclear technology. I wish we'd invest a lot more in nuclear technology. It's the political issues that have prevented us from using more nuclear energy. Look at the position that Germany is in right now. They started shutting down after Fukushima in 2000. I think it was 2011. They started shutting down a lot of their nuclear plants under pressure from the Green Party there. And so we don't, despite what you see on American political television here or just on the news, we don't actually have political extremes here in the United States. We have two parties that are actually one party that's extreme right and one party that's kind of moderately right. We don't have like a strong green lobby like most European countries, Japan, Taiwan, South Korea, and other places. They have a pretty strong green element that is able to push through policies that are never going to get pushed through here until it becomes like really economically viable to do that. So, Shoeless Joe has an interesting question. What about a pump storage solution? There's one in Scotland, one in Wales. They pump water from a lower reservoir to a higher reservoir and then let the water flow back down through turbines. So there's actually a number of projects here on a much smaller scale, though. They're doing like underwater storage, and they're calling them like gravity storage program. They're basically just pumping water up and then letting it drop through a turbine underground to power things. So I think that's probably one solution among 1,000 different solutions. And I think the future is diversification of power storage and power production. It's not going to be solely dependent on, we've had, in the United States, at least, we've had, production mostly based on burning oil, burning natural gas, or burning coal. Coal is, there are ways to do coal a lot better than we've done it, right? There are ways to do it a lot cleaner. We're just not investing the money to do that. So, so the idea that we're going to have one thing like just solar that replaces the world, world production, it could. I just don't think it's very likely. I think we're going to have a vast array of solutions, and we're going to have the energy storage solutions are the things that are going to be most impressive. And I don't know if you're paying attention to what's happening to water usage here in the southwestern United States, but the southwestern United States is not seeing it's seeing what folks are calling a 50-year drought, or a 150-year drought. If you look at more, because one of my degrees is in archaeology, and I study things on kind of a longer time frame, we aren't seeing a drought in the southwestern United States. We're seeing a reversion to mean. If you look at history on a geological scale here, this area has typically gotten less rainfall than it has in the last 150 years. And I think we're seeing a reversion to mean at this point, and we have to learn to live with less water and less water usage. So, Ben Bryan says, "Hey, Jason, great to hear from you today. Ben is one of my oldest friends, and thanks for tuning in to my live stream. Thank you so much. Just want to let you guys know the super chat features are on if you feel so inclined. I'd be happy. Yeah, that makes me happy." Eric M says, "Is solar production economic outside of China? My understanding is it's using cheap labor, cheap coal power produced at scale. I'd strongly prefer it not being in China." That's an interesting question. So I own a number of businesses, and I've tried to do a lot of things by buying from American producers. And if I can't buy from American producers, I'd rather buy from Mexico, right? I don't want to have to go to Pakistan or to China to order what I need to order, right? And I've tried, trust me, and I have talked to a number of other people in the same industries that I work in, who say, "Hey, I'm trying to get this certain item done. I want to have it done, created by an American producer. What's the best price you can give me?" And then when I'm comparing it to what I can get in China and Pakistan, I can't and the prices aren't even close. And the American producers just won't work with me at all. So my question to them is, what exactly are you going to do? We don't live in an era of trade protectionism here. You are competing with people that can produce things at 40% less than you in Pakistan or in China. You need to change your manufacturing process or you're going out of business. That message never seems to resonate with these folks. And that's kind of the issue here. Stephen Kua says, "Do you own any high dividend paying stocks?" I do own a number of high dividend paying stocks. Some of that is by accident. Some of that is based on a strategy where I definitely I'd want to have income streams coming in from a variety of sources. So residential REITs are one of the things that I own that produce high dividends. Right now, it's very difficult to go out and look for a stock that is simply paying a high dividend. All right. There's a couple of different things that you need to look at. You need to look at payout ratio, like what's covered by earnings and what is being returned to you as a return of shareholder equity in terms of like your REITs or your limited, your master limited partnerships, if those are even still a thing. But a high dividend right now, a super high dividend right now in like the 8-10% range is more of a warning sign to me right now than it is an invitation to buy that stock. What I want to see is a history of dividend growth over time. A dividend company, by definition, is one that's generally pretty mature. They're paying a dividend because they don't necessarily know where to invest all that money. If you look at Berkshire Hathaway is a holding company that invests in new companies. They don't pay a dividend because they take all the income that they make and they reinvest it in new businesses. If you look at Johnson & Johnson, they're paying out a dividend of 1.8% or something right now, based on the price. But that's a dividend that has increased by roughly 8-10% a year over the last 25 years or so. Those are the stocks, rather than high dividend paying stocks, that I'd be looking at, dividend growth stocks. A great one that you might want to look at is, I just can't think of the name of it right now, but they sell nuts and bolts, basically. I just cannot think of the name of that stock right now. Oh, Fastenal. It's ticker symbol FAST. And of course, this is not a recommendation to buy, sell, or hold any security, but Fastenal, all they sell is fasteners. They sell nuts, they sell bolts, they sell pins. This is something that it doesn't matter what the economy is doing. Demand doesn't really drop that much. They have a pretty broad strategy as far as having physical locations, having a delivery service, and having like vending machines to sell what you need. So, yeah. So in a number of ways, though, looking at high dividends right now, the price may be depressed right now because people think that they're going to cut that dividend. It may be that they didn't have a lot of coverage to begin with in that stock and in that dividend, and now we're looking at declining earnings. I think it's almost certain we are looking at a earnings recession to a degree. So if you look at the difference between the consumer price index and the producer price index right now, and I saw pretty much one of the dumbest TikTok videos I've ever seen on finance, period, where this guy talked about how the narrative that producers are just taking money from people and their, you know, record profits and all this is not true because the producer price index was higher than the consumer price index. What the guy who made that video didn't understand is the producer price index is actually a leading indicator for the consumer price index, right? So these are the prices that producers are paying. It's later on going to be passed on to the consumer, right? You don't not pass on your costs to the consumer. That's simply what you're going to do. So this is an indication that we're not done with inflation here. It's still going to increase quite a bit. So the PPI or the PPI was close to 10% and the CPI was like 8.4 or something like that. So no. So I do think in a lot of ways, though, be careful with high dividend paying stocks. The opportunity that has been around for about 2 years now that people are not jumping on is residential real estate REITs. You can get a REIT of REITs. I own REZ, which is a I forget how it's weighted, but it's actually trailing the index a little bit overall. But apartment REITs are a pretty good way to go right now. Rents aren't coming down anytime soon. And now you priced 30 to 40% of the people who were looking for home, you priced them out of the market with interest rates going up from 2.75% at the beginning of the year to roughly 5.68% beginning of the year. So 30 to 40% rise in the monthly cost of owning a home has priced a lot of people out of the market. It's going to force them into apartments, right? Force them into rental properties. The other thing that's happening right now, and this is particularly acute in Austin, Texas, and the place that I was doing research on. I've been researching buying properties with cash pretty much worldwide at this point, right? The American dollar is strengthening right now. And if you have cash for international real estate, this might be a really good time to take a look at that. And actually, where I just went on vacation, I was looking at buying an Airbnb property there. But I got pretty disheartened looking around the United States and learning that 28% of single family homes that have been bought so far in 2022 were bought by institutional buyers, right? These are like the Goldman Sachs, the Morgan Stanleys, the hedge fund companies you've never heard of. But it's particularly acute in Austin, Texas. 41% of single family homes were bought by institutional buyers. Those are going to go on the market as rentals, or they're going to sit there empty for a while until the market conditions improve. Stephen Kua, thank you so much for the $9.99 super chat. I really appreciate that. I really don't. I mean, I don't do that for the A's, but I do like to mention it on every live stream. It does make me happy when I see those. But that is this problem though with Austin, Texas in particular is particularly acute, largely because the institutional investors are taking advantage of what they see as probably going to be an influx of well-paid people that are going to be employed by Texas Gigafactory and a few other companies that are moving into that area, right? So real estate prices have long not trailed California real estate prices by very much in the Austin area. I expect Austin, Texas in the next couple of years to be pretty much just as expensive as, probably not just as expensive as San Francisco, but certainly just as expensive as LA in the future, which means you're going to have an increased homelessness problem there. And you're going to have all of the social ills that come with people being priced out of the market. And that's going to be even more acute because, like I said, 41% of all single family homes sold were sold to institutional buyers. So another problem with solar is that they'll think about it up to 20 years. So 20 years, okay. Look, it's the cost of labor and install that is the majority of the cost of the panels. The panels are actually really cheap to produce. And we're probably actually still overpaying for panels, right? There's not much in a panel, a little bit of precious metals and silicon, which is I think it's the second or third most abundant element on the planet, right? But beyond that, there's not a lot in it. So the installation process is, so they don't go bad after 20 years. What you see is you see an initial pretty sharp decline in the first like 18 months in production capacity. I forget what that's called, but it's anywhere from 4 to 8% production decline. And then you see like a 1% decline thereafter. But I know people that have had solar installs for 40 years and they're not replacing the panels. They're just adding a few more. And I'm really thinking of one of my childhood friends whose father just passed recently, who I was very close to his father growing up, but they've had solar panels on their house since the 1970s. Interesting. So, um, okay, so this is a question, and I wanted to talk overall a little bit more about options too. So why do you think QYLD has been trending down over the last 5 years while the Nasdaq went 70 cents in the same period, and how low can it go, and how sustainable is their covered call strategy? Well, the covered call strategy is completely sustainable. Now, if you own QYLD, you are not buying that to get capital gains on that. In fact, your capital gains are actually going to be fairly limited because they're selling at the money calls. That is their strategy. They're selling at the money calls and a few like slightly out of the money calls here, but they really aren't betting on that, right? So when the market declines and they're selling at the money calls and you're collecting all that premium, that's great. Your share price declines. So when the market turns around, though, what you're getting in terms of call premium is going to decline pretty precipitously. Meaning when the market turns around and goes back up for the next 6 months, especially if it's really really rapid, they are going to have to use that premium, what they've collected, in order to get back into the market and to sell at the money calls again, because now that price is going to be a lot more expensive. So if you are selling covered calls at all right now, you may want to think about taking a pause on that, because right now, let's say you've been selling covered calls on SoFi when it was at 20, you've been selling all the way down, and now it's at $5 a share. In order to make any money at all, you're selling it like $6.50 or $7 a share. You're not really making any money. The stock could quickly blow past that. Those shares would get called away, and now you have to buy in on a much higher price. And at that low price of like $7 a share, it's a pretty big multiple that you're missing out on if the price goes up to $9 a share, right? That trade now costs you like 20-30% more. So yeah, I think that in a lot of cases, though, and this is what happens with folks who are trading covered calls, is they get a little bit too greedy when the market is down, and then they get caught out. So on a lot of stocks, I'm selling covered calls so far out of the money right now because I really don't want the shares to get called away, that my income from my portfolio has dropped fairly precipitously, and I'm fine with that, right? Of course, I'd rather be buying more shares at a cheaper price right now with the premiums I'm generating with my covered call strategy. But the main thing is I really don't want to realize a loss. If I do, it means I got to stay out of the stock for 30 days before I get back in order to make that loss count on my taxes. It means that stock could run away. So I'm buying things, I've shortened my my time horizon on my covered call strategy right now down to no more than 30 days. I'm way out of the money, like 40 or 50%. So yeah, I think you should be very careful right now. This is one of the ways you can lock in losses is by being too aggressive with your covered call strategy. So yeah. But in terms of why the Nasdaq went up 70%, while QYLD has not been going up, is because you aren't invested in the Nasdaq. You are invested in at the money covered call strategy. Okay, very different. The whole thing is and I own some of this, right? I own it just to generate a little bit of income, right? To create a little bit of cash, so I have something to invest every month. So yeah. Isaiah Castillo says, I don't know if you've answered this already, but what are your thoughts on gold and silver? I've never been a big investor in gold or silver. It generally tends to take up no more than about 1% of my portfolio, largely for a couple of reasons. Gold, and it's largely correlational reasons. Gold and silver really aren't correlated to anything. I know folks say it's correlated to inflation. It really isn't. It has an opposite correlation to the stock market. It really doesn't. I really have it there because it doesn't perform like anything else. And some periods, it's been the only thing that has performed well in my portfolio. There's always going to be a demand industrially for gold and silver. So I do keep a little bit, but I don't keep a ton. I don't see it as really being this giant money-making opportunity that people think it does. It goes through long periods where it loses money. Like I think between like 1994 and 2004 or something, it lost money every year. In fact, I think it had lost money for like 18 years straight or something like that. That we could certainly go through another period like that. But yeah, so it's not a thing that I cover that much, and it's not something I think about. And part of it is because I got so gun shy. I worked for a company that had the best performing mutual fund over a 10-year period, and it happened to be a gold fund. But it happened to be a gold fund that I could not make people understand that it was a small cap gold producers fund. It didn't actually hold gold. And after that article came out that it was the best producing mutual fund in the last 10 years, it averaged like 43% over a 10-year period. People poured into the fund. And of course, once people poured into the fund, not because people poured into the fund, it was the wrong time to do it. It lost money for the next like 5 or 6 years, and everyone regretted it. And I advised against it every single time. I advised against putting more than 1 or 2% of that in your portfolio. People didn't listen. They put 50, 60, 100% into their portfolio. In fact, I knew this one Navy captain, and I never told him I told you so. But I knew this one Navy captain who poured so much of his wealth into that fund, and I can guarantee you he's never recovered that because he was already adverse to risk. He was already adverse to being in the stock market. He had all this faith in gold, and I explained to him that if you buy this fund, you are actually investing in the stock market and in small cap stocks, the most volatile portion of the stock market. He didn't listen to me. So, yeah. So Shula Joe says there's a Guardian piece about how Bill Gates is now the largest private owner of farmland in the U.S. I'll tell you something. I really appreciate British journalism. I really appreciate British journalism. Sometimes it's a little bit over the top. Sometimes it's a little bit harsh, but they do a lot better job of truly investigative journalism than has been the trend here in the United States. Although that is changing quite a bit. There's been a change in leadership in CNN. They're going to back off a lot of the political coverage, and they're going to go back to more just facts. But I really hope that investigative journalism is revived. So, I read the article too. And the overall suggestion was that not suggestion, but the sort of hint that they were trying to give you, and that a lot of folks are giving you, is that there's something nefarious going on here. It's not something nefarious that's going on. It's just good business practice. The United States produces a lot of food. Okay. A lot of food. This is one of the world's breadbaskets as well. It's a profitable industry, especially at industrial scale. And and this happens periodically where we see consolidation of farm ownership. There's actually a number of different opportunities you have right now to invest in real estate investment trusts that invest only in farmland. And I think I covered a couple of those on a live stream a few weeks back. So yeah, I'm not very nervous about that. This is something that I'm in too. I own a couple of those REITs with farmland, and that's also something that pays a dividend as well. So I love SoFi and its growth. What are your thoughts on SoFi and the vote to give the board authority for a reverse split if needed? So I don't remember the exact rules when it comes to the NASDAQ, but I think if you are on the NASDAQ and your shares are less than $5 a share for more than 30 days, you get one notice saying that, hey, you need to do something about that or get off the NASDAQ. And I don't remember what the exact rules are, but they're just preparing for that ahead of time. The story with SoFi has been nothing but growth so far. And they've even completely discounting loan origination for refinance of student loans. They've completely discounted that out through 2023, or at least through 2022. And I think that they're kind of giving up on that portion of the business model right now, and they're pretty heavily pursuing loan operations through their bank charter and other things like financial services, and of course their technology arm from Galileo. It is a growth story. You look at the impact of them not doing any loan originations, it's about $100 million, right? So their projected revenue was at $1.57 billion for 2022. They reduced that to about 1.51 down to 1.41 billion based on their last earnings call. So I am looking forward, because I know that their lending arm in terms of home loans has probably gotten crushed since April. And I suspect that their personal lines have gone up since April. And I suspect they're going to start making money on deposit operations here pretty soon. I've already gotten notices based on my account that my old cash account is no longer going to be earning interest. I need to convert it to another account to earn interest. So yeah. Hal says, solar is massive here in Australia. We have enough coverage already to power the country, and we'll eventually use stationary storage and pumped hydro to store the energy. You already have enough power enough coverage to power the country. That's actually pretty cool. Like I said, it's easier than solar's detractors want you to think that it is. It is far easier. Now, I've spoken to a number of folks in the solar industry and in the energy industry, and the 100 square miles that that Elon Musk keeps talking about is probably ridiculously naive, and we need something more like 6 times that coverage in order to just supply the electrical needs in the United States, not the transportation needs as well. But you're still looking at maybe 22,000 square miles of solar panels in the United States. 22,000 square miles of solar panels is not a lot. It really wouldn't cover that much. You could literally probably put all of those in the southwestern United States. You'd only see them when you're driving on freeways outside of town, and that energy could be transported via transmission wires to other states and other areas to power the entire country. So, and you'll probably see local production as well. Hal says we are developing time zone aggregation and super long interconnectors to move power across the country to make use of sunlight. Wind and some gas will also be used as coal is being phased out. So interestingly enough, Japan signed a deal in 2020 for a massive coal deal for some sort of brown coal that you guys have there, and that goes hand in hand with their hydrogen strategy. They have an entire hydrogen strategy for power, which I understand Japan has issues with that. They don't have any of their own energy, and it has to all be imported. Essentially, they don't have any oil, and they have this neighbor that is becoming increasingly more assertive in sea traffic. So I understand that. And Edward Gilmartin says never saw a cloud in Australia. Yeah, Australia is one country that I've never been to. I think I'd love to visit at some point. I'm planning on doing it one of these days. So keep firing away with the questions here. I did want to go back here just to SoFi for a moment. SoFi is one of the companies when it comes to my covered call strategy where I don't really have a strategy at this point because the price of the stock is so low. And when it turns around, and it's not low because of anything happening to the company specifically. And insiders are buying like crazy. They keep buying up their own shares. It's really just about fintech in general. It's been crushed over the last year. Look at what, how much PayPal has declined. Look at how much Square has declined. Look at how much everything in the fintech space has declined. I'm snapping up Upstart like there's no tomorrow. They have a stellar loan portfolio, a great business, and they've been profitable for a long time. The fact that they dropped, I was interested in them at $75 a share. I was interested in them at $150 a share. Ended up grabbing quite a bit at around $27 a share, and I just grabbed another 100 shares at around 36. So I'm snapping that up. I'm not buying any more SoFi just because I already have so much in the way of SoFi. But I don't like to have more than 10% of my net worth tied up in any single company. And if SoFi goes back up to $12 a share, it's going to be pretty close because I bought so much recently. It's going to be pretty close to 10% of my overall net worth. And I'm going to be forced to dispose of it. And I'd rather not do that because I absolutely despise paying taxes. Yeah. So, Ned Skyland says, just trade the ranges, guys, for a while. I think the QQQ sell 267 back up to 284. I tend not to do a ton of short-term trading. I'm a buy and hold kind of guy, and I generally use a cover call strategy to create more investment opportunities. Yeah. Eric M says, Bill Gates still only owns 1/20th of 1% of U.S. farmland. Is it really just 1/20th of 1% of U.S. farmland? I didn't know the answer to that. So the whole idea that the vast majority of U.S. farm production is these giant mechanized industrial farms, that's not even remotely true, right? It's not. Vast majority of farms are still family-owned farms, and usually the land is broken up between actual family-owned farms and leased land from other landowners, where the people just own the land, they'll farm it, and they do it kind of on either on a contract basis or a sharecropping basis. So yeah. Edward Gilmartin says student loan deferrals hurt SoFi. It really didn't hurt them that much. And I think they're betting on not student loan deferrals, but probably student loan forgiveness. And counter to a lot of sentiment out there, I'm all for student loan forgiveness, all for it, largely because it's public policy that really created this giant issue of wanting everyone to go to university and then we're not spending enough money to make it cheap to go to university. I have my kids will have the opportunity to go to university for free in Japan if they want to because they're dual citizens. But I didn't have that opportunity. When I went to university the first time, I was able to work a job waiting tables, and in the summertime, work on supply boats for the oil industry, or work, at a refinery, and earn just barely enough money to pay all of my tuitions, all of my books, and literally live off $25 a week while struggling to wait tables. I was able to do that because basically my tuition cost, a couple bucks for four potatoes, and a bag of dirt. It was really that cheap. It was really cheap. It was something like tuition and books was like $2,500 per year when I went to university the first time. The second time I went to university, it was $30,000 to go to a state university, right? To one where it was supposed to be publicly funded. It was $30,000 a year to go. And now that's closer to $45,000 a year to go. You can't wait tables and pay for that. Like even minimum wage here in California at $15 an hour, and plus you wait tables somewhere, at best you're making $25, $30 an hour. Paying $45,000 a year in tuition plus plus $20,000 to live somewhere, you don't have any money to eat, right? So you are forced to take out loans. And scholarships are not an option for everyone. Military service is not an option for everyone. But even folks that have a GI Bill where you're paid an E5's BAH, E5 with dependents BAH, which in San Diego is like $2,700 a month on a tax-free basis. That's your living stipend plus your tuition up to the state maximum, and you get a small stipend for your books. It's all paid for. Even with that, you're seeing veterans having to take out student loans just to make ends meet while they go through college. And it's because we have not made the investment in our universities to make it cheap enough for people to go, which means we have, especially when it comes to men, we have fewer and fewer and fewer men getting educated. There are far more women at camp. This is one of the reasons men should go to university, of course. There are far more women getting educated here in the United States than there are men right now, and men are kind of falling behind on education. It's not to say that everyone should go out and get a college education. You can make six figures a year as a plumber. You can make six figures a year easily as an electrician. And you don't have to be in the biggest markets. I know plumbers in rural Texas that make 90 grand a year working for someone else. So, I think that you don't have to go out and get a college education, but it's in our best interest for the future of our economy to have a population that's educated enough to do this. I remember when I used to hire people for programming projects, not being able to find people, even folks that had a computer science degree, not being able to find people that had the basic education to make things work for the projects that we were working on. They just weren't educated enough to do it. They were smart enough. They just didn't have a background in anything useful. And they weren't even getting that at university. So, but we're shooting ourselves in the foot future-wise by making it so expensive to go to university, where if you go to Finland or you go to Japan or you go to South Korea or Taiwan or China, or even in Latin America, like Colombia has free universities there. Mexico City has free universities there, where your tuition is basically free. It may cost like $30 a year or something like that. We need to make maybe not quite as substantial, but similar investments in education. And maybe we need to bring something back like France has like a baccalaureate where it's a really strict exam where we eliminate people who really shouldn't be going to university. So, So Nets guy says, look at GPS, good price and great divvy. Okay, here. I opened it here for starters, and they're going to turn this thing up from here around 6% divvy around GPS. So typically, I don't know much about GPS. So let's take a look at that here. So hold on just a second, guys. Let me pull this up. And let's take a look at what they do first. And let's take a look at their dividend. Markets are down a little bit here. And for some reason, my quote lookup is not working. It did this the other day. The gap. Okay. No, the gap is, never mind. The gap is absolutely not something that I would be investing in at this point. And the 6% dividend would be more of a warning sign than anything else. I don't believe that they're paying a 6% dividend that's actually supported by their business. They have this massive drag in terms of physical retail locations. Most of those are in malls. The 6% dividend means that they're probably paying out some shareholder equity at this point too. I would look for that dividend to get cut here in the future. So Frederick Pillow says, is it smart to cut some losses now? So I put a poll up on my YouTube community yesterday or the day before. It was the day that I couldn't do a live stream because something came up, where I asked the question: Is the market going to go down further? Are we already in a bull market, or is it going to go down a little bit more, or is it going to go down a lot? We could already be in the start of a new bull market. Remember, the bull market, the new bull market, always begins really, really in advance of the end of the recession. We are probably in a recession right now. We're probably in the second quarter of a recession. We're looking at what I think is probably the normal end of the credit life cycle, where we're going to see a contraction in credit. We're going to see a slight decline in GDP. We're going to see some rise in unemployment here in the future. That hasn't quite happened yet, but we'll probably see a rise in unemployment here. And we'll see a reset in terms of inflation when we see demand decline. It's not the end of the world. It's the end of an economic cycle. It happens all the time. It's just that it takes so long for these cycles to happen that people forget that it happens. I think that it's probably too late to cut your losses, especially if you've been invested for a long time, and that coming up with a smarter strategy to invest new money is probably the way to go at this point. Because of how you use losses, I don't know if your gains are all in, or I don't know if your funds are all inside of a tax advantage account or if they're in a brokerage account. If they're in a brokerage account, remember the 30-day rule. If you sell a stock, in order to make that loss useful against any other gains you make for the rest of the year or against regular income, you need to stay out of that stock for 30 days, or 31 days, or that loss is disallowed. What can happen in the next 31 days? Like I said, this week has been a relatively easy week in terms of news. In terms of a market like this, no news is good news, right? So beginning next week and the week after that, we have a lot more economic news coming out. I expect a little bit more volatility, but I think we're going to bounce around 3,600. 3,600 is where the market is pretty much fairly valued for the end of the credit cycle, let's say at the beginning of January 2022. If that multiple, remember I talked about this in my prior live streams, where the multiple between increase in earnings and the increase in price to earnings ratios was kind of flipped this time around, where we saw a 70% of the market gains was due to the increase in price to earnings ratios, and only 30% of it was really because of earnings growth. Now that we've seen that flip, we've reverted back to where the market as a whole is probably fairly valued at about 3,600 for the top of the market. So if we see a 10% decline from that 3,600, I wouldn't be surprised, right? That's kind of where I wouldn't be surprised. And if it bounces back really quickly from there to line up with corporate profits, because we're going to see a little bit of a what's called an earnings recession here, where we see corporate profits are going to be down, not because of a decrease in revenues. They're going to be down because of increased costs. Those eventually get passed on to, those costs get passed on to the consumer. It causes a decline in demand, which causes a reduction in our supply chain issues. So I think it's too late in order to think about cutting your losses. This is really one of those times where sticking to your guns in this kind of market, you're not going to see this as the best decision to make until 5, 6 years, 7 years down the road. I don't want to see you cut out of the market right now. You've got to stay out for 30 days or your losses are disallowed, and then having a buy back 30, 60, 90 days from now at prices that are much higher. You feel better making that move, but the reality is you probably missed out on a 20 or 30% run up in that market, and it's going to depress your returns for a decade, 2 decades, right? The strategy of trying to time the market fails for most people. They just get it wrong because we can't predict the future, man. We just can't do that. So I don't think, if it makes you feel better and it's the only way that you can sleep, then go ahead. But in terms of whether it's probably the smarter move to do, it's probably not, right? I don't know what the market's going to do. You don't know what the market's going to do. And we could already be in the beginning of that next bull market. Look at the last really major recession we had in 2008, 2009, where the market hit bottom March 9th of 2009. The recession didn't end until January of 2010, but the market was up 57% in the middle of a recession while the economy was still contracting between March 9th, 2009 and January 10th, 2010. We had three more quarters of decline, of GDP decline. And people didn't even know that the GDP was still declining until those numbers came out in January. And yet the market was up 57% in that intervening period. If you waited for the economy to feel better, right, in order to get back into the market, and this happened with a lot of people that were my clients that I could not convince to stay in the market. They didn't get back in the market until 2011, 2012, 2013, which means they missed out on roughly an 80% gain in that time period, right? So staying invested a lot of times prevents you from having taxable events, prevents you from miscalculating and not being able to use any losses that you do realize. And a lot of times when you buy back in later, you're buying fewer shares at a higher price. So no, I don't think that would be the best move to do, especially now. The best time to do that would have been in November of last year, right? If you could have foreseen that was the top of that credit cycle. So folks always ask me why I'm not panicking. It's largely because this is just the natural end of a credit cycle. We do have some additional issues here. Inflation, look at the history of every inflationary event that we have had since World War II. It has never been about how much money we're printing. It has always been about supply shock. It's always been about supply shock. The big event, 73 to 82, was the one where Paul Volcker had to come up with new solutions. That was still precipitated by supply shock, right? So we're looking at events from 1945-46, massive inflation, all due to increased demand. 1949 and 1950, increased demand due to fear of rationing again. We saw a massive supply shock and a huge spike in prices. 1953, the end of the Korean War, massive supply shock because of increased demand, everyone coming home and buying crap, right? We saw it again, 68 to 73. We had years of full employment, hot economy, and rising wages, and that caused a supply shock. People just buying and buying and buying. The response in those intervening time periods from the government was wage and price controls. We cannot do that today. No one has the political will to do that. And the reason we tried wage and price controls is because we really didn't understand what was going on and with inflation and how to tame it. In 1973, of course, we came off the gold standard, right, or the remaining gold standard. We really came off in 1913, but weaned ourselves off of it completely in 1973. Additionally, I think that was actually 1968, but additionally, we had oil shock because of our involvement, because we supplied the Israelis with weaponry during the Yom Kippur War. The Soviets were on the other side, of course. OPEC and a number of other countries boycotted us. Price of oil went through the roof, right? And that was literally because they wouldn't sell us oil. It was very different than what's happening today. And the response to that was to engineer a crash in the economy to attract dollars back to the United States by offering higher term debt. We essentially exchanged high inflation for a really large debt burden here in the U.S., and that's something we still haven't solved, a question we still haven't solved today. So the issue today, of course, is the same and different than what happened in the past. You never want to compare two historical events and say they're exactly the same. The cause is exactly the same. It's supply shock in this case. The response that I don't want to see is exchanging inflation for really high U.S. debt. I want to see a balance sheet roll off from the Fed. I want to see higher interest rates. And honestly, we are at full employment. 3.6% unemployment is essentially full employment. There's always going to be some people out there that are in between jobs. They're changing jobs for one reason or another. There's always going to be some company that goes out of business. There's always going to be a certain amount of people that are milking the system and just don't want to work, right? But the reality is basically everyone that wants to work is working. There is no one left to hire. And that's not great for the economy. That causes wage inflation, which almost always causes people to be able to afford to buy more, which is just contributing to the pent-up demand that we already had from before, where people weren't really able to spend money on a lot of experiences. And that's the other thing. I went out this summer, went on vacation, and went around, ate in restaurants, learned a new language,
talked to people, laid out on the beach, did what I want to do. I spent all my money on experiences and not things, right? And that's what and I got to experience how there's chaos right now in the service industry as well. But a lot of the money right now that we're worried about that's pushing commodity prices up right now, that's pushing manufactured things. I think that consumer, and this is actually borne out by numbers, not just me thinking it. Consumer spending is actually is shifting away to experiences. You're looking at Target and Walmart saying they're selling a lot more gift certificates than they have in the past, like dining out and things like that. A lot of that's changing, right? So here, see, if Biden doesn't make a decision on the moratorium over the next month, do you think SoFi could drop again? I think SoFi has largely, or investors in SoFi have largely priced in the fact that there's going to be a $50,000 forgiveness of debt, right? I think that's priced in. I think it won't be $50,000. I wish that it was. Like I said, this is enormously stimulative in a way, which is bad for inflation, but it's better for the economy down the road years from now. 92% of all federal loans are actually owned by the Treasury Department. Do we really want 40 million people owing $1.7 trillion in debt to the U.S. Treasury Department? Is that really what we want for our country? For an education we told them they needed to get in order to be a functioning member of society. And there's a couple of individuals that I always think about this where they borrowed $50,000, $60,000 for a future that simply didn't happen. Meaning they borrowed $60,000 to get an MBA thinking this was going to propel them in the next step in their career. And they got a $4,000 raise. And that's not even covering the interest on the loans that they took out. Don't get me started on the MBAs, man. I think the vast majority of MBAs are just a giant ripoff. And this happens every time there's an economic crisis. Somebody doesn't know what to do, and they go and get an MBA, and the corresponding $40,000 to $60,000 in debt for a 2-year, master's degree, and it doesn't really help their career out in the long term. And a lot of folks are doing this in their 50s and 60s, right? This is not going to help your career. This is not in 99% of the cases, this is the wrong thing to do. This is my firm opinion on this. So I think that student loan debt is worse for the economy. I'd actually rather see a shift in priorities from money being spent in certain areas, and let's spend more of it on secondary education. Let's spend a lot more on secondary education. So, but do I think it'll drop again? How much further can it drop? And if it does drop further, then we're probably looking at that reverse split, which I hate reverse splits. Reverse splits rarely work out for the company, and the stock usually drops another 20 to 30% immediately after that reverse split. But yeah, so anyway, folks, keep coming with the questions, or we're at an hour and 15 minutes here. Keep coming with the questions, or I'm gonna think that it's probably time to get off. So Shoeless Joe, thank you so much for always contributing to my live streams. Frantic Pillow as well. Net Sky Limit, unless you are a regular user that just change your username. I don't remember you, but thanks for joining today. Edward Gilmartin, I know that you've commented before. Eric M, also a frequent commenter on my live streams. Hal, once again, nice to see you from Australia. Nice to hear from you from Australia. Lima, I think you are a new, either a new commenter, but I wanted to acknowledge that. Thank you so much. Isaiah Castillo, you frequently comment on my live streams as well. Thank you. I'm sorry I didn't have much more of a robust answer for you in terms of silver. Mark T, excuse me. Pretty sure that you've commented on my live streams before. Thank you for tuning in. Stephen Kua is actually, I think he's my latest Patreon member. I don't talk about my Patreon that much on this channel, and that's probably the reason why I don't have that many members in there. But if you guys want to check out my Patreon at some point, it's $5 a month. We have a really intelligent community of people there that share knowledge that's pertinent to technology investment. There's no politics going on. There's no unpleasantness. I'm not putting up with it. So Goldmine, I think you've commented on my live streams before. Thank you for commenting again. And let me see here if there's any new questions. All right, no new questions here in the last few minutes. So I'm going to call this one a day. Today is Wednesday. I'll be back tomorrow at 1 p.m. As long as I'll be back as long as nothing comes up, and I don't think anything will. I'll be back tomorrow at 1 p.m. Thank you very, very much, folks, and have a nice day. enjoy this little breather in the stock market. I don't think volatility is over, but I think right around 3,600 is probably kind of not necessarily where the bottom is, but it's a spot to kind of mark, on the scale of where the market's going to go. Anyway, thank you so much, and you folks have a nice day. I'll see you tomorrow.